Picture this, a 167-year-old Swiss bank. One of the most prestigious financial institutions in the world. The kind of place where billionaires, celebrities, and world leaders kept their money. A symbol of Swiss precision, discretion, and trustworthiness. And it all came crashing down in March 2023, but here's the thing, Credit Suisse didn't fail because of bad luck or a market crash. It failed because for decades, it knowingly helped drug cartels launder cocaine money, enabled dictators to steal billions from the world's poorest countries, and turned a blind eye to accounts linked to terrorists and human traffickers. This is the story of how one of the world's most respectable banks became a criminal enterprise hiding behind Swiss banking laws. And here's what should terrify you, they weren't the only ones doing it. For over a century, Switzerland built an entire industry on one promise: secrecy. Swiss banking laws, some dating back to 1934, made it a criminal offense to reveal client information. Not just against company policy, we're talking prison time for bankers who talked. This wasn't designed for privacy. It was designed for plausible deniability. Credit Suisse was founded in 1856 to help fund Switzerland's railways. By the 20th century, it had become a financial giant managing over $1.4 trillion in assets. That's more than the GDP of most countries. They had offices in 50 countries and employed 45,000 people. But behind the marble lobbies and the impeccable Swiss reputation, Credit Suisse was running what one U.S. senator called a conveyor belt for dirty money. Here's how the system operated. You're a corrupt politician, a drug lord, or running a Ponzi scheme. You need to hide your money. You can't just deposit $50 million in a U.S. bank without questions. But Credit Suisse? They offered numbered accounts. No names, just numbers. Even better, Switzerland wasn't part of the European Union. They had their own rules. And those rules were designed to protect one thing: the money, not justice, not victims. The money. For decades, Switzerland argued this was about privacy. But let us be real. Law-abiding citizens don't need bank secrecy laws that protect them from criminal investigations. The only people who benefit from absolute secrecy are people hiding something. Let's start with one of the most brazen examples: the Bulgarian drug trafficking ring. In 2021, Credit Suisse was convicted in a Swiss court, and pay attention here because Swiss banks almost never get convicted in Switzerland. They were found guilty of allowing a Bulgarian cocaine trafficking organization to launder millions through their accounts between 2004 and 2008. The Bulgarian mafia wasn't subtle. They were moving massive amounts of cocaine from South America into Europe. We're talking about a drug operation that destroyed lives across 2 continents. And their banker? A Credit Suisse employee who not only opened accounts for them, but actively helped them structure transactions to avoid detection. Here's the insane part. Credit Suisse's own compliance department flagged these accounts as suspicious multiple times. Red flags were everywhere. Large cash deposits. Transactions from known drug trafficking routes. Accounts held by people with criminal records. And what did Credit Suisse do? Nothing. Absolutely nothing. Because those accounts were profitable. This reveals something crucial about how modern banking crime works. It's not that banks don't have compliance departments. Credit Suisse had hundreds of compliance officers. They had sophisticated software designed to detect money laundering. They had policies and procedures that looked great on paper. But none of it mattered because the business side of the bank didn't want to know. There's a term for this: willful blindness. You create systems that look legitimate, but you make sure they're just ineffective enough that profitable dirty money can still flow through. You ask just enough questions to cover yourself legally, but not enough questions to actually stop the crime. Credit Suisse didn't accidentally help drug traffickers. They systematically created an environment where helping drug traffickers was more profitable than stopping them. If the cocaine trafficking made you angry, this next one will make you furious. Mozambique. One of the poorest countries on earth. In 2013, the GDP per capita was about $600 a year. Half the population lived in extreme poverty. And Credit Suisse helped government officials steal $2 billion from them. Here's how the scheme worked. Mozambique's government wanted to develop a tuna fishing industry. Sounds legitimate, right? Economic development, jobs, food security. So they took out massive loans, about $2 billion. Guaranteed by the government. Credit Suisse arranged these loans. They knew where the money was going. Except the money never went to tuna boats or fishing infrastructure. Instead, government officials and their associates pocketed the money. They bought luxury properties in London, yachts, private jets. Meanwhile, Mozambique was left with $2 billion in debt that its citizens, people making $2 a day, would have to repay. But Credit Suisse wasn't just negligent here. They were active participants. They received massive fees for arranging these loans. We were talking $200 million in fees and commissions. And U.S. prosecutors later revealed that Credit Suisse bankers knew the projects were fraudulent. How did they know? Because they didn't do basic due diligence. They didn't verify that the tuna projects were real. They didn't ensure the money was actually being used for fishing boats. Because if they had looked, they would have had to admit what was obvious. This was a theft operation, not a development project. 3 Credit Suisse bankers were eventually indicted in the United States. One of them, Andrew Pearce, pleaded guilty to conspiracy to commit wire fraud. He admitted he took bribes and kickbacks while arranging these fraudulent loans. The human cost? Mozambique's economy was devastated. The country defaulted on its debts. Poverty increased. Public services were cut. And the victims? Ordinary Mozambicans who never saw a penny of that $2 billion but would spend generations paying it back. This is what banking crime actually looks like. It's not dramatic bank robberies. It's men in suits and boardrooms deciding that stealing from the poorest people on earth is an acceptable business strategy. By 2021, Credit Suisse was already hemorrhaging reputation from scandals. But then came Archegos Capital Management, and this one cost them $5.5 billion in a matter of days. Bill Huang ran Archegos as a family office, essentially a private investment fund, but Huang had a history. He'd previously pleaded guilty to wire fraud in an insider trading case. He was banned from trading in Hong Kong for 4 years. So naturally, Credit Suisse decided to lend him billions of dollars. Huang was using a strategy called total return swaps. Essentially, he was making massive, leveraged bets on stocks without actually buying them. And he was doing this with multiple banks, each unaware of how much total exposure he had. When his positions collapsed in March 2021, it triggered a cascade. Credit Suisse was left holding billions in losses. Goldman Sachs and Morgan Stanley got out early. They saw the warning signs and dumped their positions. Credit Suisse? They held on too long, apparently believing Huang would recover. The Archegos disaster wasn't just about poor risk management. It revealed something deeper. Credit Suisse had become so desperate for profits, so willing to ignore red flags, that they would lend billions to someone with a fraud conviction. This wasn't an accident. This was the inevitable result of a culture that prioritized profit over everything else, over ethics, over safety, over basic common sense. By 2022, Credit Suisse was in freefall. The scandals kept coming, their stock price was collapsing. Major clients were withdrawing their money. In 1 quarter alone, clients pulled out $110 billion. Then came the final blow. In March 2023, Credit Suisse announced they had material weaknesses in their financial reporting. Translation: we can't guarantee our numbers are accurate. That's a death sentence for a bank. Banking is built on trust. If clients don't trust you to accurately report your own financial condition, they run, and they ran. Within days, Credit Suisse lost $10 billion in deposits. The Swiss government panicked. They couldn't let a bank this big fail. It would crater the entire Swiss financial system. So they forced UBS, Credit Suisse's biggest rival, to buy them. The price? About $3.2 billion. Remember, this was a bank that once had $1.4 trillion in assets. It sold for roughly the cost of a few Manhattan skyscrapers. But here's the bigger story. Credit Suisse's collapse marked the end of an era. Swiss banking secrecy, the system that enabled this corruption for decades, is dying. U.S. pressure, particularly through the Foreign Account Tax Compliance Act, forced Swiss banks to start sharing information. The U.S. Justice Department prosecuted Swiss bankers. They imposed massive fines. They made it clear, if you help Americans evade taxes or launder money, we will come after you, regardless of Swiss secrecy laws. And it worked. Switzerland started signing tax treaties. They began automatically sharing financial information with other countries. The numbered accounts that once made Swiss banks attractive to criminals became liabilities. Credit Suisse wasn't just a bank failure. It was the failure of a system built on secrecy and moral blindness. Here's what keeps me up at night. Credit Suisse got caught. They failed. But were they unique? In 2023 alone, major banks paid billions in fines for various forms of misconduct. Deutsche Bank, HSBC, Standard Chartered, JP Morgan, all have faced serious allegations of money laundering, sanctions violations, or facilitating financial crime. HSBC admitted to laundering $881 million for Mexican and Colombian drug cartels. They paid $1.9 billion in fines. How much did they make from that business? We don't know. But they're still operating. The business model is simple. The profits from dirty money exceed the fines for getting caught. It's just math. If you make $10 billion from criminal clients and pay a $2 billion fine when caught, you're still up $8 billion. The Credit Suisse story reveals an uncomfortable truth. Our financial system isn't designed to stop money laundering. It's designed to profit from it while maintaining plausible deniability. We've created a system where banks can claim ignorance even when the evidence is obvious. Fines are just a cost of doing business. Individual bankers rarely face prosecution. The banks themselves are too big to fail and get bailed out. Think about this. Credit Suisse helped steal $2 billion from Mozambique. They paid about $475 million in fines related to that case. They kept the rest. That's not punishment. That's a business transaction. Real reform would require personal accountability. Bankers who knowingly facilitate money laundering should go to prison, not just pay fines. Proper penalties. Fines should exceed profits from criminal activity. If you made $10 billion from dirty money, you should pay $20 billion in fines. Transparency. And the remaining banking secrecy laws. They serve no legitimate purpose. Enforcement. Regulatory agencies need more funding and independence to actually investigate major banks. But here's the reality. None of this is likely to happen. Why? Because these banks are too powerful, too politically connected, and too essential to the global financial system. If you're watching this, here is what you need to understand. Your money is in the same system that enabled Credit Suisse. The bank where you keep your checking account? It's connected to this global network. When banks launder drug money, that fuels violence. When they help dictators steal from poor countries, that causes poverty and instability. When they facilitate tax evasion, that means you pay more in taxes to make up the difference. This isn't abstract. This isn't just rich people's problems. Banking crime affects all of us. Credit Suisse's collapse should have been a wake-up call. A 167-year-old institution destroyed by its own corruption. But 6 months after they failed, most of the global banking system continues exactly as before. The executives who oversaw these scandals? Most retired wealthy. The compliance systems that failed? Still basically the same everywhere. The regulators who missed this? Still in charge. We're told Credit Suisse was an outlier, a bad apple. But the evidence suggests something different. They were just the ones who got caught. So ask yourself, if a bank as big, as established, as respected as Credit Suisse could be completely corrupt for decades, what does that tell us about the rest of the system? The answer should terrify you. Because somewhere right now, another respectable bank is opening another account for another drug cartel, another corrupt official, another criminal enterprise. They're just being more careful than Credit Suisse was. The question isn't whether it's happening. The question is, when will we actually do something about it? If you found this investigation eye-opening, subscribe for more deep dives into financial corruption. Next week, we're investigating HSBC's role in laundering cartel money and why they got away with it. This story isn't over.